IndiGo and Spicejet have been the biggest beneficiaries of Jet Airways grounding, or so it seems. The two budget carriers moved in swiftly to bid for vacant slots left by Jet Airways, and in Spicejet's case, also leased some of the planes. And the share market has also rewarded the airlines, largely, let's put it that way, but despite a small correction of late. But which of the two are a better bet right now? Samit Sarkar is attempting to find an answer to that. Samit, how are you doing this?
So firstly, to understand which company is better placed, we need to see the current scenario of the aviation industry, which will give us a better perspective of why is this important to know. So currently, if we see the aviation industry is seeing a fall in its yields or the ticket prices. Now that is because of higher capacity addition coupled with its slowdown, which is leading to competition in the industry. Secondly, if we see on the cost side, the costs have remained very volatile for the aviation industry. Crude prices and dollar both have remained volatile throughout the year. And thirdly, both the companies are facing aircraft-related issues. For Spicejet, the 737 MAX have been grounded, while for IndiGo, A320 neos have been grounded because of engine-related issues. So among all these factors, which of the either two is better placed? Firstly, at IndiGo. Now, IndiGo's cost per unit is lower compared to Spicejet. On an average, in the last 5 quarters, if you see, its cost has been lower by at least 17%. Now, this in itself gives IndiGo an upper hand because if the yields are falling, a lower cost will still help the company to report profits. So this is one point for IndiGo. Secondly, if you see, IndiGo has a very strong balance sheet compared to Spicejet. Now, balance sheet health is very important in an airline due to the volatility in the business that we see. And if you see, majorly all the airlines fail because of a weak balance sheet and not because of a weak operating environment. Now, if you see IndiGo's balance sheet, its free cash on books is close to 8,700 crore rupees, and it has a debt of only 2,378 crore rupees. Liquidity ratio, that is cash as a percentage of annual revenue, stands at 26.1%. Now, on industry average should be around 20%, which is considered as safe and sound, but for IndiGo, it is 26%. And Spicejet, on the other hand, it has cash of only 92 crore rupees, a debt of close to 920 crore rupees, and a liquidity ratio as low as 0.87% compared to, if you see, the last 12-month revenue for these companies. Now, if you see the third factor, that is IndiGo is a bigger player. Now, both in the domestic and the international market, IndiGo's size is nearly 3 times that of Spicejet, and even with such a huge size, IndiGo is still aiming to grow at a 20% plus capacity going forward. And lastly, as the company is looking to add more than 50% of its incremental capacities on the international route, the company's risk related to forex and fuel cost will already come down because fuel charges are lower on foreign routes, and forex volatility will reduce because as more international routes come into its profile.
What about Spicejet, Samit? Where does it score? Where does it falter?
For Spicejet, if you see, currently their costs are higher, but this also gives the company a headroom to reduce its cost. Now, company has started its own initiatives to lower costs, which is visible in the second quarter of financial year 2020. As you can see, the company's cost compared to IndiGo is higher by only 20%, as against an average of around 30% in the previous 4 quarters. Now, going forward, the company is aiming to reduce this gap to only 10%, that is in financial year 2021. Now, secondly, if you see, Spicejet has been the key beneficiary of a fall down of Jet Airways, as it got most of the vacated slots of Jet Airways, which aided its expansion. Now, in the second quarter of financial year 2020, the company increased its capacity by more than 50%, which was the highest in the last 4 years for Spicejet, and this has been aiding the company. And lastly, unlike IndiGo, Spicejet has not seen any issues with its promoters or the management, which has been a positive thing for the Spicejet. Now, this factor does not impact the financials as such, but it still remains an overhang on the companies, that is on the company that is IndiGo. We are currently seeing an overhang, but Spicejet has not seen such kind of overhang, which is related to ownership and promoter. And lastly, one common factor which will aid both these companies, that is IndiGo and Spicejet, that is return of their key airplanes. That is for IndiGo, if you see, that would be A320, and for Spicejet it would be 737 MAX. Now, these return of both these planes would help the company increase its cash flow and also lower its cost, because both these planes are fuel efficient. So overall cost will come down for both these companies. So the final score between IndiGo and Spicejet stands at 4 for IndiGo, and for Spicejet it stands at 3. Now, do remember, this is completely based on our understanding, and after we spoke to market experts and analysts, this is what we get to know, that IndiGo is still better placed when compared to Spicejet in the current scenario.
Samit, I have a small follow-up question. When I speak to almost anybody in the markets, they speak about how Spicejet has an issue of the balance sheet concerns, the funding concerns, the cash on its books, and how it's dependent on a lot of other variable factors for it to continue moving ahead smoothly. How serious is the situation? How manageable is it? And would Spicejet need to do some immediate fundraising in some fashion or the other in order to continue flying smoothly, if I can use that term?
So if you remember, we had done this story earlier last week. I guess we had done this story where we had compared Spicejet's balance sheet with IndiGo and what we and the current scenario if you see in the market. What we spoke to various analysts, and what we got to know from that is that yes, Spicejet's balance sheet is weak when compared to IndiGo, but that has been the case for Spicejet for at least the last 4 years. And if you remember the last year, that is the first half of financial year 2019, the situation was bad when compared to the current situation. In the last year, if you remember, the yields were falling and the costs were continuously on a rising trend for the airline companies. But Spicejet still managed to come out of that during that situation. So currently, if you see, Spicejet can still manage with this low cash on its book because it is still generating a good amount of operating free cash flows that has been coming for Spicejet, and that has been aiding the company's expansion. But if the current scenario continues for at least the next 2 or 3 quarters, then Spicejet might start to feel the heat because of yields are falling down continuously.
Okay, just one last follow-up. Would seasonally this, because of the December month, be a high month of flying, and therefore is it expected that the October, November, December month fundamentally could be positive for both the carriers?
Well, actually, it is not expected to be a good quarter. It is usually a strong quarter. There is a third quarter of any financial year, but this time it cannot be that. It is not expected to be that strong because of falling yields and because of a rising cost scenario. Because you can see because of the rising cost scenario and because of the falling yields.